Hi, friends. Chris Kelly here. Hey, late in the week, time to look at what's going on in the world of real estate. We're going to look at it today the way we always do, with the same. I use the same graphic every week, but I also grabbed some Q1 data that really that our company puts out, and most companies do a version of it, but it breaks it down by city and by number of units sold by city, days on market, all of that. I just thought it was maybe good to take a little deeper look at that. Just in the name of resilience, the market remains quite resilient, to be honest. So let's dive into that. I'll minimize me and I'll grab that guy. There we go. So we're off a little bit in the new listing count and the pending count, but nothing significant. This time last year, we didn't really have a change in the units sold, but this time last, we're still off a bit in closed transactions from this time last year. So there's still, all of this still has to, this right here, this comparison, I'm looking at last year's pending versus sold in a given week versus this year's pending versus sold in that same given week. And I've talked about this a few times. This has been kind of the story of things right here, that larger disparity between pending and sold. And the only real answer to that is transactions aren't sticking nearly as much as they were a year ago or the year before or the year before. This number's off a bit. So last year, this week was an anomaly. There were more sold than went pending. Most of the time, that's not the case, as you can see by going back over the years. It can happen, but we're off a bit still, which means some transactions aren't sticking through and making it all the way to closing. It's really the only answer. Again, this disparity here between a relatively short or low, rather, median days on the market and a relatively high average days on the market means that there's some listings out there sitting, and those are screwing up the average. And that's the very reason that I look at these both together. This is a more general indication of the pace of the market. That 15 days, that's a pretty good clip. Best case scenario, we were at 5 days. That's a huge anomaly and not indicative of how the market normally works. And we're only 10 days above that on the median. But look at what, the average was. It was 16 and 27 respectively. Even last year, it was at 53, which meant more listings were selling and less listings were sitting a long time and screwing up the average. So that number is bigger, which means simply this: if you're if you're wrong on your price, there's a huge possibility you're going to stay wrong. In other words, the market isn't going to catch you. So it's important to be right on price, and if you're not, to make the adjustment in a timely manner. That's really what that is. Let's see. I'm going to minimize me again and maybe take a look at pricing. So this is a quarterly report, like I said, that our company puts out, and we zoom in a little on it so it's just easier to see. But it breaks it down by area. Northeast Portland, Southeast Portland, etc. And you can see where average sold price is last year versus this year. The purple or burgundy is this year. So, some markets are off a little. Most markets are off a little bit in price, not all of them. By and large, pricing is, you can see from this that it's staying relatively flat and maybe coming down ever so slightly in some areas. But by and large, it's staying relatively flat. And this column over here, average days on market, it's kind of back to what I was just talking about. I look at it on a weekly basis, and I look at the median and the average. It's a way better indicator to look at them together. But this still gives you a nice broad brush view of what's the pace of the market this year versus last year. And by and large, it's faster. There's a couple of differences or standouts like Sandy isn't in Q1. It just wasn't. But and some of these, like what's this? Canby wasn't. But most of these are really close, if not slightly faster or lower as far as the average days on the market. So let's see. There's one other graphic I wanted to look at. Oh, this is the closed units. So the actual number of closed units in Q1 of 2024 versus 2023. I mean, you can see in some areas like, Portland, Northeast, Southeast Portland, pretty notably different, a lot less this quarter of 24 versus last year. But go over to, like Gresham, Troutdale, or Milwaukee, or Beaverton, and we're slightly higher. So it seems to me, not across the board, but it seems to me that as you go out a little bit, the markets have fared better in 24 versus 23 compared to closer in. Let's see, there was another page of that graphic. Oh, and this just kind of got into the other parts. Like here's Sandy, pretty close, pretty similar. Sherwood was pretty similar. Tigers down a little bit. Tiger Tualatin. So, but this was good information. Had a little bit deeper dive into some of the numbers than what I put out. And what I put out is on a week-to-week basis. So it's nice. And when you look at them over time, you can kind of really get an idea trending. But sometimes it's nice to look at the Q1 and even a half year or annual stuff. A lot of times I'll put out the national stuff. And that's where I started today. Actually, I was looking at some national numbers and it just didn't seem as relevant. And I knew that this information from Q1 was available. So I decided to go there. Hopefully you find that of interest. It's, like I said, by and large, the market's resilient in the face of the cost of money edging up again. It edged up, started coming down, then it flattened and edged back up. The Federal Reserve has seemingly indicated that they're going to kind of hold the line on the Federal Reserve rate, which affects mortgage interest rates. And really what that means, in my view, is it's going to push the inevitable. It's going to push it out. So, a lot of the people I listened to that thought, 2024, we were going to see rates come down, particularly in the second half. I would suggest that that's going to kick into 2025. It's not the end of the world. It just means that the trajectory of what's going to happen got pushed out a bit. That's all. It's still, the thinking is still the same, right? You can't fix the price you pay for something, but you can always fix the cost of the money you borrow to pay for that asset. So, if it takes, but it could take longer before money gets cheaper and a refinance could happen. And that is, it's not an unimportant consideration. But I still maintain that once money does come down in price and it hits a threshold, a bunch of people are going to enter the market much more than the inventory is available. And so pricing is going to go up, and it's going to go up fast when that happens. So, for the most part, one would be better off paying less for that property and borrowing a little bit more expensive money for a time, provided you can, and there's a comfort level around it. So don't get me wrong, the financial piece, the financial metric is not unimportant. It's hugely important. It's just not the only consideration. It's kind of back to that whole, the drum I beat, is it the right time in your life to be doing whatever it is you're thinking that you want to do? I mean, that's where residential and primary residence purchasing is concerned. That's a big deal. It's a huge consideration, probably the most important one. So anyway, I hope you find that helpful, because that's my goal. Here's my other goal: to be here, to be of help to you and yours. If there's anything going on, there's questions, things that we can be doing to offer assistance, I want you to know we're here. So feel free and reach out, ask questions. If it's such that we can help you buy or sell something, great. And if we can just answer questions, that's fine too. So anyway, as always, we're here for you. So, and with that, I will say until the next time.